All right, in chapter 8, we are going to talk about GDP. Okay, so we're going to talk about how it measures total production. Does it measure what we want it to measure, the difference between real and nominal GDP, and then there's also other measures of total production and total income. GDP is the main one, but we will talk about other methods as well. So now we are going to go into the macroeconomics portion of the textbook. So with microeconomics, we focus on households and firms, how they make their decisions, how they interact with each other in markets, how the government intervenes and influences their choices. Whereas with macroeconomics, we're going to study the economy as a whole, and GDP is a big piece of that. And we will also cover other topics like inflation, unemployment, and economic growth. Okay, so some very important terms to know and have under your belt. The first one is business cycle, and this is alternating periods of economic expansion and economic recession. So it's an economic expansion, and this is the period of a business cycle when total production and total employment are increasing. And then a recession is the opposite. This is where total production and total employment are decreasing. Economic growth is the ability of a country to produce increasing quantities of goods and services, and then the inflation rate measures the change in price level from one year to the next. Okay. So gross domestic product is the most commonly used measure by economists of overall economic activity in the economy. Okay, so there's other measures, but GDP is the one most focused on. And so what gross domestic product is, it's the market value of all final goods and services produced within a country during a period of time. So what we normally see GDP measured at is in quarters. So quarters would be, every 3 months. So January through March is quarter one, April through June is quarter two, July through September is quarter three, October through December is quarter four, and then also yearly. And so you can also think about this as, this measures the total income of a country as well. So let's break down the definition. So the market value of all final goods and services. So market value means is that the goods that are counted in gross domestic product, the goods and services, they are counted as what they sell for in the market, what people buy them for. So we need a standard way of being able to measure production. And so this is how they decided to um, include and measure these goods and services. So when we look at final goods and services, we look at the good and service purchased by the final user. This good will not be used to produce another good, for example. And this is so we don't double count, because there are some goods that are intermediate goods and services. So for example, we count what the wood table sells for to the household. We don't count what the carpenter paid for the wood, because that would be double counting. So the final price that the carpenter sells the table for should already include the cost of the wood that he purchased to make the table. And in this example here, for example, we don't count what, let's say, like Ford bought the tires for. What we count is what the truck sold for, because the final price of the truck should include the cost, for example, of the tires, the cost of the aluminum, the cost of the leather. So we don't want to have double counting. So we don't count what we call intermediate goods and services. And intermediate goods and services are inputs into another good or service to make the final good during a period of time. So again, normally when we see GDP quoted, it's either in, quarterly time periods or yearly time periods as well. And when we measure output, yearly, then we measure the goods and services that were produced only in that year. So, it doesn't matter when the goods are sold. We count the year that they are produced. So if, something was produced, let's say a truck was produced in 2019, but it didn't sell until 2020, that truck does not get included in 2020 GDP. It gets included in 2019 GDP, the year it was produced, not sold. So we are going to focus on GDP being a measure of production, but it can also be a measure of income. Why? Because all the goods and services that are produced and sold, the money that's used in those transactions, it goes as income to households and firms and the government. And so they both are valid measures of economic activity. So we see here there's a circular flow diagram. And, just to break it down on its very basic level, we have households and firms. So households buy goods and services, and then that goes as income to firms. And then firms use that income to pay wages of their labor. I mean, where do they hire labor from? They hire from households, and then interest, rents, and profits as well. If we add in the government sector, then we see that households and firms both pay taxes to the government. And then the government will buy goods and services from firms, and then they will pay wages, interest, and transfer payments to households. So transfer payments are payments to households in which the government does not receive a good or service in return. So an example of a transfer payment would be welfare, financial aid, Social Security, subsidies for certain businesses, etc. So we also see an interaction with the rest of the world. So for example, households will buy imports, and then foreigners will also buy exports, US exports as well. And then we also have the financial system over here. So households put savings in their financial systems, and then they also provide borrowing. Financial system provides borrowing for firms. It also provides borrowing for households as well, and it provides borrowing for the government. All right. So if we look at all the goods and services that are produced in the economy and purchased, we see that it can be broken down in four main categories. And this is the first one is consumption. That's what households spend on goods and services. And then the second one would be investment. And this is, households' purchases of homes, for example, and then firms' purchases of like land, capital, equipment, etc. And then government spending, and then net exports. And net exports is exports minus imports. So exports are counted because they are produced here in the United States, even though they're sold abroad, but those goods and services are produced here in the United States. And imports are not counted because those goods were purchased abroad. Those goods were produced abroad. So they're not counted in the production of the United States because they were not produced in the United States. All right, so consumption is spending by households on goods and services, excluding houses, because housing is counted as investment. Why? Because you're paying to eventually own land, and land is considered investment. But everything else that households spend on is considered consumption, such as, education, clothing, haircuts, medical care, etc. So a little note here, non-durable goods. These are goods that don't have a long life cycle. They last 3 years or less. So like food is a non-durable good. Clothing tends to be a non-durable good, for example. And then they also spend on durable goods. And these are goods that are designed to last a long time, such as automobiles and furniture. Investment. So a quick note here in economics, in this course, investment does not mean stocks and bonds or cash like it does in finance. Okay, what it means is goods that are used to produce other goods. So new factories, um, office buildings, any type of machinery, any addition to inventory. So a quick note about inventories. So goods that are produced, that have been produced but not yet sold, they go under investment, under the subcategory inventories over here. Okay, so that's very, very important to note. And then any spending by the government at the federal, state, and local level goes under government purchases. And transfer payments are excluded because this is just simply a transfer of income from one household to another. They are not, transfer payments do not produce goods and services. It's just a transfer of income through the tax system. And then net exports. So net exports is, again, exports minus imports, because we are looking at domestic production. So exports are counted because even though foreigners buy our exports, they are produced here in the United States, and then imports are excluded because, again, even though they are purchased here in the United States, they were produced abroad. All right, so if we look over here for 2016 components of GDP, we see here in the United States that our largest component is consumption. Almost 70% of our GDP consists of consumption, followed by government purchases at 17.6%, then investment, and then our net exports actually takes away from our GDP. Why? Because we import more than we export. So it's a negative number. And we see here that, and this, let me just get my pencil here. Um, and these categories here that we spend the most on services. So like, haircuts, for example, education, then we do on non-durable and durable goods. And then we see here under investment, residential investment, this is like households buying homes. It's about 706, and then inventories account for some, but it's usually just business spending, and then government spending, and then we see here that we have more imports than exports. And so in 2016, GDP was $18.569 trillion. This was the total production of goods and services within the United States. There is another method in measuring GDP called the value added method, and this is where um, every stage of production of a certain good is counted. So it's still leads to the same conclusion when we look at what the good sells for. It's just here we're looking at the value added at each stage of production. So, if we're looking at a shirt produced by LL Bean, it's on sale, or it's for sale for $35 on their website. And so first we look at the value of raw cotton. So that's $1. That's added by the farmer. And then the value of raw cotton woven into the cotton fabric. So that was $2. Okay, so it was $3 minus the dollar they paid for the cotton. Then the value of the cotton fabric made into a shirt, let's say that's 15 minus the 3 from the textile mill, and then the value of shirt on sale for sale. So over here, it's 35 minus the 15 for production, so it's 20, and then all of these added together would lead us to the total value added of $35. So that's another way we can measure GDP. So GDP is very useful in measuring the total output, total income in an economy, and a lot of times we look at GDP per capita, meaning GDP per person, and it's used as a measure of well-being of citizens. And there is some merit to this because countries that do have a higher GDP per capita tend to have longer life expectancies, tend to have higher rates of education, for example, than countries that have very low GDP per capita. But it does have shortcomings as both a measure of total production and a measure of well-being. And we're going to go into this right now. So its shortcoming as its measure of total production, one of them is it doesn't include household production. So, there was a study done by economists, and if you could put a wage to, let's say, what a stay-at-home parent does in terms of work, the cooking, the cleaning, the raising their children, etc., it would be like $75,000 a year of production. But it is not counted because, this is not a service that is sold in the markets. And then also, it doesn't include the underground economy. So, there's a lot of buying and selling of goods and services that is concealed from the government so people can avoid taxes or because the goods are illegal, such as drugs, etc. And so, a lot of times, GDP, if is undercounted. So, if you were to include both of these items that we just talked about, it would be higher than what is reported. So while we compare GDP year to year, it's the value of household production in the underground economy probably stays around the same percentage wise. So when we look at GDP growth, it is a reasonable measure of the growth in total production. But over longer periods of time, over 10 years, 15 years, these shortcomings, can be more pronounced. What we have seen is women have entered the workforce in larger and larger number. And so, as they're working, then they're outsourcing the household production. They're hiring people to clean their home. They're hiring childcare, for example. And so this is actually counted in GDP. So, these increases in GDP may exaggerate the increase in actual total production. And what we see is in some countries, in developing countries where there's a poor rule of law and weak court systems, a lot of uh, economic activity is done in the informal sector, meaning the underground sector. So that way they can avoid regulation, they can avoid taxes, they can avoid government seizure of their private property. And so in some of, it's estimated in some of these developing countries that the informal sector can be about half of their economy. The other shortcomings of GDP is the GDP does not tell you the value of leisure time. So you have countries, especially in Asia, where people are literally working themselves to death. They work so many hours. So yes, their living standards are high, but it doesn't measure their well-being. It doesn't measure their value of leisure. And also with increased production comes the externality, the negative externality of pollution. And so GDP does not measure the effect of that on our well-being. It doesn't measure crime and social problems, nor does it measure the distribution of income. And so, we can see the US has growing inequality. If you look at it per person, okay, you can say the average income in the United States is 55,000 a person, but what we see is a lot of it's concentrated in the top, 10%, for example. And it's even worse in countries such as Saudi Arabia, where you have a few oil billionaires and then a lot of poor people. But if you look at their total GDP per person, it looks like they're a middle income country. Okay, so since GDP is looking at the market value of all goods and services um, produced, we need to be able to separate how much of an increase in GDP is due because of inflation, because the prices of these goods and services are rising, And how much of it is due because we're actually producing higher quantities of goods and services. This is important because we can be producing the same exact amount of goods and services year after year, but if the prices rise year after year, it looks like we're producing more, but in reality, we're not. It's just that we just have higher levels of inflation. And so we need to be able to look at true growth of GDP, meaning if we're actually producing more quantities of goods and services. And so we do this by looking at real GDP. So with real GDP, we keep price level the same. So we choose a base year. So if we choose 2009, then what we do is in 2010, 2011, 2012, 13, up until now, we use today's current quantities produced in 2009 prices, because if we keep the prices the same year after year after year after year, then price level isn't changing, then we can truly see how much quantity is changing. If we keep price level constant, then we'll be able to see the change in quantity. And so the BEA, the Bureau of Economic Analysis, chooses a base year. The current standard's 2009. And so they have different methods of, making sure to keep the price as stable as possible in order to be able to see the true growth in quantities of goods and services produced. So here's an example. Let's say the economy consists of eye examinations, pizzas, and shoes. Okay. So in 2009, if we were to calculate total GDP, or total output, we would add all this together. So 80 eye exams times $40 each gives us $3,200 worth of eye exams. 90 pizzas times $11 each gives us $990 worth of pizzas. And then 15 pairs of shoes times $90 each gives us $1,350 worth of shoes. So total production in 2009 was $5,540. Now, if we want to look at if we truly produce more goods and services or not, then we would calculate real GDP. Because if we look at nominal GDP, let's just do nominal GDP for a second, okay? Nominal GDP would be just taking, 2019 quantities and multiplying it by 2019 prices, okay? Over here, so we're just multiplying here. So this is, 5,000. This would be 800. And then this would be 2,000. And it gives us a total of 7,800 over here. So yeah, if you look at just purely nominal GDP, then you would say, yeah, and GDP has increased in production. We were at 5,540 in 2009, and 10 years later, we're at 7,800. But what we see here is that prices from 2009 to 2019 changed. And so, for example, for eye exams, the price increased by $10. So we want to know, like how many more eye exams did we really produce? Because it can be, let's say for 2019, there were 80 eye exams. Okay. So 80 times 50, we have 4,000. Okay. All right. So, but in reality, did the quantity of eye exams increase? No. What ended up happening is the price of eye exams increased, and it made it look like we actually produced more eye exams, but we didn't. So what we need to do is we need to keep prices constant. Let me go back here. Okay. And keep current quantities. So to calculate real GDP in 2019, what we're going to do is we're going to take 2009 prices and multiply it by 2019 quantities. And when we do that and add all those together, we see that real GDP was $6,680. So yes, we did produce overall a higher amount of goods and services, but it's not as much as it looked like when we looked at purely nominal GDP for 2019. So if we looked at nominal GDP, it would have looked like it would have been 7,800. But in reality, this was prices and quantity increasing. So what we do is we keep price steady so we can only look at the change in quantity. And so yes, we did produce a higher quantity of goods and services for 2019. So we see here when 2009 is the base year, real GDP is higher than nominal GDP, but after 2009, since prices have increased, nominal GDP is higher than real GDP. So when we hear the growth in GDP in the news, so for example, GDP has increased, 1.5% from one year to the next, then it's usually real GDP that's been quoted. So economists, policymakers, they are very interested in the price level, and that's the measure of the average prices of goods and services in the economy. And this is important because they want to make sure that price level overall stays steady. So, this is one of the goals of the Federal Reserve, for example, because this allows households and firms to plan for the future appropriately. So, if price levels are steady and they're not jumping around all over the place, and households and firms can better plan their future spending and purchases. Then if not, if there's a lot of uncertainty, then what we see is like current spending will drop just because there's not much certainty there. And so, they use the GDP deflator to be able to know if they're achieving price stability. And what the GDP deflator is a measure of the price level. And it's found by dividing nominal GDP by real GDP times and multiplying it by 100. So in the base year, the GDP deflator will always be 100 because nominal and real GDP in the base year are the same. And then what we have here, for example, let's look at nominal and real GDP for 2015. So if we were to do the GDP deflator formula, it'd be, nominal GDP divided by real GDP times 100, so we get 110. And in 2016, doing the same thing, we get 111.4. And remember, in this case, the base year was 2009, so 2009 will be 100. But what we can do here is once we have the GDP deflator, then we can plug it in the percentage change formula, which is, new minus old divided by old times 100. And, so we do the newer year, 2016, so 111.4 minus, 2015, 110 divided by 110 times 100. And so we can say there's been a 1.3% inflation or increase in prices from 2015 to 2016. Other measures of total production and total income, one is gross national product. And so this is production performed by citizens of a nation, including overseas production. So, if the US citizen is working, let's say in Germany, then the value of the goods and services they're producing there get counted in GNP. And also, let's say it's a resident here in the United States, but they're not a citizen yet, that is excluded from GNP. And then national income is GDP minus the consumption of fixed capital. In other words, GDP minus the depreciation of the fixed capital. Personal income is income received by households, including transfer payments. And disposable personal income. And this is personal income that's left after households are done paying their taxes. So this is important to know, how after households are done paying taxes, how much income do they have left to spend on goods and services, because this does have implications for future GDP. The more disposable income they have, then the more they tend to spend, the higher GDP tends to be. And then the less they have, then the less they tend to spend, less GDP. Okay, so we see if we look at measure of GDP for 2016, $18.569 trillion. GNP is 18.776. National income, 16 trillion. Personal income, 16 trillion. And then disposable personal income is 14 trillion. National income is always smaller than GDP because it's the same as GDP, but minus the depreciation of the fixed capital. And national income tells us a couple of things. If a growing or an increase in national income would mean that there's economic stagnation going on because the capital is not being used as much. So there's lower rates of depreciation. If capital is not being used, that means lower rates of production. And it also lets us know, the future cost of replacing these capital goods that are undergoing depreciation. And when we look at gross domestic income, we see, most of it comes from wages. And then, interest also accounts for as part of income. So, people are saving in the bank and they're earning interest, for example, or if they own land and are renting it out, rent payments, and then any types of profits and profits of sole proprietorships, like an individual business, or profits of corporations as well. Okay, this concludes chapter 8.